One stock, though, that is up right now is Wells Fargo. We're following that breaking news coming out of the bank, raising $10.65 billion in a share sale, pricing them at $25 per share. Bill Fitzpatrick of Optique Capital Management joins us now on the phone from Milwaukee. Now, Optique Capital owns around 200,000 shares of Wells. And Bill, good to have you on the phone. Your reaction to this capital raise?
Hi, good morning, Betty. Well, clearly, I think the B of A and Citigroup news forced the hand of Wells Fargo. Truly, I did not think the capital raise was necessary. But at the end of the day, the marketplace is very happy to see the overhang, the TARP overhang, be removed. And this remains a best-in-class bank. So for Wells Fargo to be pulled in with Bank of America and Citigroup really isn't fair to Wells Fargo. This is really just an earnings machine. This is a company that cross-sells their products better than anybody, and they have the earnings power behind them that B of A and Citigroup don't have right now. So I'd look at this very favorably if you remove the $10 billion capital raise.
Okay, but it's not going to change your stance, as you were just saying, on the bank. And it doesn't matter to you whether or not that they jumped the gun, because it does seem like that they were basically pressured by their peers.
Yeah, I think that's exactly right. I think it's an interesting chess match between the regulators and Wells Fargo that took place. Clearly, the regulators wanted the money returned. The Obama administration wants to reallocate these funds, and Wells Fargo didn't want to raise $10 billion in equity. And unfortunately, it was Wells that gave in first. But on the heels of B of A and Citigroup, I think they were forced to do so. So, sure, the capital raise is dilutive. We're not happy about that as existing shareholders.
Yeah.
But as you can see from the stock price today, the marketplace is reacting very favorably.
And Bill, I mean, any of this, you think, in reaction also to the fact that as these banks pay off, they don't have the overhang of the government on them. I mean, does that matter to you as a shareholder?
Yeah, it certainly does. Now, keep in mind, Wells didn't have exceptional assistance, so they weren't subject to the compensation restrictions. But clearly, nobody wants the government overhang meddling with your businesses. And once that's removed, now we're back to letting the capital markets do their thing. And I think that's what's viewed so favorably by investors right now.
Right, and okay, and viewed favorably, but also, as I was reading through some of the reports about Wells and raising this money in a share sale, it also, in some ways, may be a good thing because it may prevent Wells from having to sell some assets off in order to raise capital. Will it not?
Yeah, I think that's fair to say. And I think if you look at some of their competitors out there, they've been forced to sell what I would call core assets, which clearly affects the earnings power of the company going forward. So you've got to ask yourself what's in place when the economy finally does rebound, which we're starting to see right now. And with Wells Fargo, you still have that earnings power in place. And that's where this best-in-class franchise comes into play. And that's a distinguishing characteristic from Wells versus all their competitors right now. So they're going to be very, very well positioned in the event that we do get a rebound in the economy.
Okay, so what's next for Wells, Bill?
Well, they're perfectly fine now from a capital level. For whatever reason, the regulators have been focused on this Tier 1 common, which is a ratio that Wells have been a little bit less than their peers. But their regular Tier 1 is over 10% now, so they're perfectly fine from a capital perspective. They've got their management in place. I don't think you're going to see any more deals. It's possible you could see them go after a small regional bank, but I think they're just fine from that perspective, and I think it's just more bread and butter, getting back to core banking and doing what they do best.
Okay, all right. Thank you so much, Bill, for joining us on the fly there. Bill Fitzpatrick of Optique Capital.